Valuation reflects AI promise, but fundamental upside remains limited. 3Q results slightly ahead on revs and 400 BPs ahead on margins enabled Palantir to mark its fourth quarter of GAAP profitability. Key takeaways: Palantir delivered another narrow top-line beat in Q3, with revenue of $558 million. U.S. commercial remained strong with an acceleration to 33%, 52% ex-strategic investments, and better deal velocity amidst AIP and a new GTM initiative. U.S. government remains weak at 10% despite Palantir's reported involvement in multiple geopolitical conflicts and federal sector strength in other prints. Estimates are largely unchanged with an inline Q4 guide, and we see valuation as too demanding for the lack of upside. U.S. commercial traction continues, but no meaningful upside to estimates. Palantir delivered a narrow top-line beat as Q3 revenue of $558 million came in just above the high end of guidance and an acceleration from prior quarters. Much of the acceleration continues to be driven by the commercial segment, which outperformed expectations, marking 23% YoY growth on the back of U.S. commercial strength. U.S. commercial remains the primary focus for management as the new product cycle surrounding artificial intelligence platform, AIP, and a reinvented go-to-market strategy are brought to the forefront to drive a continued acceleration in the segment, initial signs of which are largely encouraging with 1. U.S. commercial growth accelerating to 33% YoY from 20% YoY last quarter to 52% YoY from 37% YoY ex-strategic investments. 2. U.S. commercial remaining deal value growing 23% YoY and 27% sequentially ex-strategic investments. And 3. Number of deals over $1 million closed in the quarter accelerating to 80 from 66 last quarter. However, while not dismissing the positive signs of early momentum, we believe this is generally reflected in estimates, which remain largely unchanged coming out of this quarter, while weakness in other parts of the business continues to rear its head. Namely, U.S. government continues to remain a weak spot, growing only 10% YoY. Despite the company's reported involvement in several of the ongoing geopolitical conflicts, and despite broad-based federal sector strength in other software prints, management continues to view this dynamic as a matter of timing and retains its constructive view on the U.S. government business on a go-forward basis. On the bottom line, Palantir continued its cost-cutting by reducing operating expenses a sequential basis, flat YoY, resulting in 400 BPs of operating margin outperformance and its fourth quarter of GAAP profitability. While the pivot to profitability has proven material upside in the trailing 12 months, management is starting to signal that it will begin to invest again where possible on the ramp PDD line to drive its product innovation. Net, our estimates remain largely unchanged coming out of the quarter, with Q4 guided in line and FY23 guidance flowing through the very modest upside in the quarter. While Q4 operating margins are 100 BPs ahead of our model, as a result, we see estimates largely reflecting the early U.S. commercial momentum and remain UW. However, we do move up our bear case valuation to $6 to reflect the profitability upside, which we view as a reasonable downside scenario. What worked well in Q3? Q3 commercial revenue growth accelerates. Commercial revenue grew 23% YoY, which was up 8% sequentially, driven by an acceleration in U.S. commercial and a more modest step down in the strategic investment contribution. U.S. commercial revenue growth accelerated to 33% YoY from 20% YoY in Q2 and grew 52% YoY ex-strategic investments, compared to 37% YoY in Q2. Operating margin results and guidance top estimates. Margin surprised at 29% against MSCI consensus at 25%, with total operating expenses flat YoY and declining on a sequential basis. Looking ahead, management raised its Q4 operating income guide 31% implied margin, which is ahead of consensus estimates. TTM GAAP profitability achieved. The company reached GAAP net income, the fourth quarter in a row of GAAP profitability. Management continues to expect the business to be GAAP profitable throughout FY23. Strong free cash flow generation. Free cash flow, representing a 24% margin, which puts the company at $500 million of trailing 12-month free cash flow. Areas to monitor. Q4 and FY23 revenue guidance lack meaningful upside. Q4 revenue guidance came in at flying 18% to 19% YoY, which was in line with MSCI consensus despite the top-line outperformance and acceleration in commercial growth in the quarter. Management changed its FY revenue guidance, which implies an unchanged 16% YoY revenue growth and does not provide meaningful upside to prior guidance. Q3 government business remains challenged. Government revenue grew 12% YoY from 15% in Q2 as the U.S. government business underperformed with 10% YoY growth and a sequential increase of only 2%. Management remarked that the timing of contracts remains lumpy. We estimate that the international government business grew 22% but also grew only modestly on a sequential basis. Revenue guidance benefits from larger strategic investment contribution. Total revenue guidance previously reflected 3% of strategic investment revenue in FY23 and now implies FY23 contribution is higher at 4%. Adjusting for this strategic investment upside, Q4 guidance was below consensus estimates. Underweight Thesis. Our UW thesis is predicated on 1. Expected delays in AIP revenue contribution given early stages in the product cycle and broader AI investment cycle. 2. Risk that the government business, which has recently also started to deteriorate, including both international and U.S. government, may not be able to offset a top-line deceleration. And 3, a difficult setup as estimates already imply an acceleration in organic revenue growth ex strategic investments and Japan JV contribution, which sets a higher bar for positive estimate revision necessary to justify valuation, in our view.